challenges that they've had to face, deaths in their family, you name it. And with each of those challenges, they had a decision to make, to either become stronger as a result or to become defeated, to let that take away their pursuit of that success. And as you can imagine, has Tom Brady ever lost a game? Absolutely. Has he ever thrown an interception? Absolutely. Has he ever thrown the ball just in the total wrong direction and the guy missed the pass? Absolutely. He's made plenty of mistakes throughout his career, just like any other individual who has pursued success. But the measure of our worth, the measure of our success is not determined based upon our mistakes, but it's dependent upon the fact that we keep moving forward. We grow from that. We learn from those experiences, and we ultimately then can accomplish those higher goals that we have set for ourselves. And in addition to that, I want to share this thought with you. Mastering the skill of trading is a challenge for everyone. Okay, we acknowledge right up front that learning how to trade in the markets, understanding price action, one of the concepts that we're going to be talking about today, and all the other principles that we teach, there's no question. When you're first starting out, it feels like a challenge. You look at all of it and you say, this is overwhelming. There's so much information. How will I ever get it all down? But for those who are willing to invest the time, that's the thing of value you need to bring to the table. Brandon and myself and all the other educators, we're here to give you all of our knowledge, but ultimately you have to invest your time in order to, and if you do, this can become one of the best things to ever come into your life. Now you say, well, no, the relationships are the best thing that came into your life. Absolutely. But if you want to change your financial future, if you want to take things to the next level, to be able to provide for those people in your life, then you need to master this skill. Invest the time, take the time. The first question I always ask people when they come up and they say, man, I'm just not getting this, and I'm struggling here, I don't understand this or whatnot. The first question I always ask is, are you plugged in? Are you plugged in to the training that is available to you? If you're not plugged in, then how are you going to have this information, right? If you're not on our sessions, then you're missing out. If you're not going back and watching recorded calls, you're missing out. You have to invest your time in order to play the game and have success, okay? Tom Brady and his whole team, and even everybody else on the other team, right? They're practicing day in and day out. Game day is not the only time you play. You do a lot of preparation. And when it comes to trading and learning in the markets and so forth, it's no exception. We invest the time to learn and master the skill. And so my encouragement to you today is to commit that time. Look at your situation and say, do I have currently that which I desire in my life? Whether it's your relationships, your finances, your business goals, financial goals, etc., you want to make sure that you are working towards those goals that you desire. And if you don't currently have them, then chances are you need to do something differently. You need to make the decision to commit yourself, to invest that time to do what it takes. And as you do so, that's when you'll start to see the results. A person who's playing basketball, they have to go out and practice shooting the hoops. They'll never get better at shooting if they don't practice. Well, guess what? The same is true with trading. If you don't go and learn the skill, but also practice, go out and execute some trades, make some mistakes, lose some money, all that kind of thing, you're not going to learn the skill set. Okay, so make sure you're plugged in, make sure that you're investing the time, and as you do so, this can become one of the best things ever to come into your life. I can say that personally because it has definitely been that for me. I have invested literally thousands upon thousands of hours. Over the last 5 years, Brandon introduced this to me about 5 years ago. I immediately began investing the time. I knew it was going to take time. And as I invested more time, the more clarity I gained, the better vision I got of where this could grow. And the more it helped me even to endure the hard times. You see, this wasn't just a perfect, straight up linear road, to success for us. We had our own trials. We had our own struggles. We had our own days of losses and setbacks and all those kind of things that everybody goes through. And it's kind of like getting injuries in sports. It's going to happen. But again, the measure of our success is our ability to persevere through those hard times and keep moving forward even in the face of obstacles. And so, again, our encouragement to you today, invest the time, do what it takes to master this skill. Now, as we begin our discussions today of the markets, we're going to be covering some basics, and I want to review some of the IM Academy services, and then we're going to jump into actually reading the charts and talking about how you can take your trading to the next level. So as a quick review, we know there was a lot of new people that joined the business over the weekend, so we want to cover a few basics real quick, and then we'll get into some of these IM Academy services such as CashTrap, Go Liberty, etc. So when we look at the chart, the big question when you're learning to develop and master this skill, the question to ask yourself is, which way is price going to go next? It can only really go up or down on any given minute of the day. And our ability to make money is dependent upon our ability to accurately make that price direction prediction. So we're saying, is price going to go up or is price going to go down? And if we're correct on that, that's where we make our money. Now within HFX, it's a little bit different than normal Forex trading or normal futures trading or commodities, etc. And the way that it is different is that rather than the price needing to go a certain distance, in other words, like if we looked at Bitcoin, for example, it recently just went from $39,000 up to $44,000, right? So that's distance. It went from 39 to 44. That's a $5,000 increase in the value of that price. That's kind of the traditional way that you make money. So you make your money depending on how far that price goes, how many dollar increase that price would make. And even if you're playing the market in the downward direction, even if you can play the downside, it's the same thing. You need that distance. You need price to drop, say, from that 44,000 back down to 39,000, and that's how you'd make your money in the normal Forex or futures markets. With HFX, it's a little bit different. We do need the price to go in the correct direction that we have predicted, but only by within a certain amount of time, and we don't need distance at all. In other words, if price goes up, if we predict that price is going to go up, and it goes up even 1 pip or just $1, right? So if we looked at Bitcoin, and it went from $39,000 to $39,001 by the time our trade expired, then we win the trade. It's as if it went all the way to 44,000 and we took profit. It's the same basic concept. And so this really simplifies the trading process because now we only have two variables. We need to predict price direction within a given amount of time. Those are the only two variables that we really consider with regards to whether we win or lose that trade. Now, our analysis obviously includes more than that, but just at a very basic level, this is the whole of what we do within high frequency Forex. And so as we predict price direction, the question is, well, how do we know which direction price will go? And that's what we'll discuss today. But it's important to understand that this is really a simple two-step process: determine price direction, and then assign a time expiration. That could be anything from 1 minute, 3 minutes, 5 minutes, 15 minutes. It could be really any time. You could pick up to a month long and say, you know, if price goes up from where it's at right now by the end of the month, then I'm going to make money. Or if it goes down, you know, if we want to place a put option, that's what a downward price direction prediction would be called. And so if we predict that, it's referred to as a put option. If we predict it's going to go up, we refer to that as a call option. And so again, we predict that direction, and we assign a time expiration. And with that, we teach you how long to choose. We have specific rules, objective measures on how to choose your time expiration. That's not to say you always have to do exactly what we suggest, because there are many strategies out there, and there are a lot of ways that people can be successful with this. But it's definitely a good place to start. And it's based upon the evidence of all of the trades that we have tested and strategies that we've tested over the years. All right. So it's very important to understand what moves the market. In the market, there's constantly buyers and sellers. Now, it's important to understand that buyers and sellers in the open market are a little bit different than what you normally think of in terms of a buyer and a seller. Now, if you go down to your local grocery store, you are the buyer, right? You're going to walk into the grocery store, you're going to buy a gallon of milk or a dozen eggs or whatnot, and you are the buyer, and the store is the seller. They've got the product. You're the consumer. You're going to take that. You're going to purchase those products and walk out of the store. You hand them your money. That's the nature of the exchange. Well, when we're talking about the Forex market or even the futures market or commodities, all buyers and sellers are buyers, essentially. In other words, we're all placing orders. We're all entering the market, but with a directional prediction. Sellers predict that the price will go down. Buyers are predicting that the price is going to go up over time. The more sellers there are in the market, the more the price goes down. The more buyers there are in the market, the more the price goes up. And so as there's an imbalance between buyers and sellers, that ultimately causes price to fluctuate up and down. And so As we're looking at the markets, we simply need to identify, are there more buyers or are there more sellers? And technical indicators and other tools help us to identify exactly that. So, but it's very important to understand that everybody in the market is, in a sense, a buyer. We're all placing orders, putting money on the line, but with a directional bias of saying, we think the price is going to go down based on the evidence that we're seeing. Other people are saying, we think the price is going to go up based on the evidence we're considering, right? And both can actually be right, depending on the time frame that they're considering. And some people, for example, in your normal retirement accounts, 401ks, IRAs, they're kind of a buy and hold strategy. They're saying, we predict the price will go up over the next 30 years. And so we're going to put this client's money into this particular mutual fund or into this stock or whatnot. And they're expecting the price to go up over that lengthy period of time. That's a buy and hold strategy. Well, when we do HFX, we're trading the market in both directions because we recognize that price doesn't just go in one direction. If you look at this chart here, you can see the price went down and went up, goes down, up, down, up, down. Every green candle, the price went up. Every red candle, the price went down. And so price is constantly moving in both directions. And so we simply need to determine where the early signs are that there are more buyers than sellers, or more sellers than buyers. And as we get good at identifying those early signs, that evidence, then we can, with a high degree of accuracy, determine which direction price will likely go next. Now, as part of our overall market concept, there is what's referred to as volume and volatility. Volume simply refers to the number of orders, the total number of buyers and sellers in the market placing orders into the market and putting their money in and saying, we believe it's going to go in whatever direction. That volume creates stability to the market, and it also creates volatility. Now, normally, if you think of volatility, you say, well, volatility sounds unpredictable. It sounds dangerous. And if you were out in the ocean, you want calm seas, not volatile seas, right? But the reality is when we're trading in the markets, we're not worried about volatility. In fact, we want volatility. Volatility simply means that the waves are bigger. And to illustrate this, we've got this little diagram here. So on the left side of this blue vertical dash line here, you can see that we've got that same tug of war between buyers and sellers. The more buyers there are, price goes up. If there's more sellers than buyers, the price goes down. And so during this low volume, low volatility time of day, we see a lot of these candles that kind of have these long wicks, but most of the bodies are very small, repeated, and price really isn't going in any given direction. Once the market opens up and that there's a lot more volume, it creates that volatility. And you can see to the right side of this blue vertical line, how price really moves up in a big way, it moves down in a big way, and the wave patterns become predictable. We're not seeing all these erratic kind of spiky movements. We're seeing that price is consistently either moving up or moving down, and we can begin to make very accurate price direction predictions and assign a specific time expiration and with a high probability of winning those trades. And that is a result of more people participating in the market. So when the large institutions, the banks, the big brokers, the market makers, et cetera, as they start to funnel literally hundreds of billions of dollars at any given moment into the market, that creates movement for any given currency pair, commodity, or whatnot. The Forex market is a $6.6 trillion volume market per day. And, and so all of that volume is produced and inputted into the market by these large institutions. So highly liquid marketplace. And so you want to make sure that you're trading during a time when there is good volume and volatility. We like to see these kind of things. And I'll talk to you about how to identify when that is. But generally speaking, you can even see in this example how a lot of these candles are very small, a lot of wicks and so forth. Whereas here you're seeing more taller bodies to the candles, more consistent wave formations. And that's just kind of a telltale sign that you have a high volume versus low volume time of day. Now, as we look at the price waves and movement of the market, it's important to understand that there's an overall architecture to these wave patterns. We can actually begin to see some consistencies and patterns to how these waves form. And we categorize these different wave patterns into three different phase types. One is consolidation, indicated by this blue line here. And during a consolidation phase, you have consistent top and bottom pivot points to the waves. Pivot meaning simply that the price changed directions. Price went up, it stopped, and then went down. That point at which it turned around, we refer to as a pivot point in the market. These pivot points become future points of reference where we can look to place a trade, either as for a reversal, which is commonplace in consolidating markets, where we can look to place put options at each of these top points, call options at each of these bottom pivots. But when the market begins to either move into expansion or trending times, we then want to have a directional bias where we want to trade with the trend. Now, an expansion phase, just so you understand kind of what that is, and I'll show you an example of that. An expansion phase is typically a very short-lived time of the market when a lot of new institutional money and volume is coming into the market, and you see price begin to break out above a consolidation phase as well as below. And it doesn't have to go in that order, but you'll see these breakouts above, breakouts below the top and bottom pivot points of the consolidation range. And then, but it usually doesn't last very long. It'll kind of be a bunch of green candles, bunch of red candles, bunch of green, and then it starts to trend, right? So we typically don't trade in expansion times. We will note them. We can see when they happen. But typically, most of our objective trade rules actually keep us out of expansion phases of the market. And so the next is the trending phase of the market. Now, in a trending phase, ultimately what that means is that price is consistently moving in one direction. Now, price moves up and then down all the time, even in a trending market. But where we're looking to enter the market is after each of these breakouts, beyond a previous pivot point, as price comes back down to that previous level, we're then looking for a trend continuation move. In other words, we have a bias in an uptrend. We want to place only call options. If we can identify that we're in a downtrend, we want to place put options. And so identifying which phase of the market that we're in as our first step is very, very important to determine that directional bias. Again, we make our money by determining price direction. So if we can first identify the market phase, we say, hey, we've got breakouts to the upside. We're in an uptrend. Already, we have an edge on the market. Because now it's just simply a matter of identifying a likely location where the price will utilize as a launch pad and start to keep going up. It's as simple as that. And now all of a sudden we go from guessing in the market to where now we can identify with high probability areas or locations at which price will likely go in our favor. And so that is how we ultimately make our money and can interpret what price is doing. For those who are brand new, the big question that often burns in people's mind is, can we really predict where price is going to go next? That's the big question. Because at first, without understanding some of the inner workings of understanding price action, technical indicators, etc., it sort of just feels like we're rolling the dice, right? Price will go up or down. We've got a 50-50 chance, just place a trade, right? But that is definitely not what we're doing. This is a skills-driven, technical analysis-driven trade approach. Now, there are other trade approaches. Some people focus on fundamental analysis. Some people could theorize, and based on a lot of popular opinions and market sentiment, that Bitcoin is going to go up, and they could place a buy and hold strategy and wait for 2 years, and it probably will go up, right? That's one type of strategy. Technical analysis simply means we're looking for price patterns, and we're looking for technical indicators to give us trade entry reasons on very short-term trades. Short-term meaning we're not waiting for 3 years. We're not waiting for 5 years. We're waiting maybe for 3 minutes or 5 minutes. Very short time periods, and we can still make the same amount of money as the guy who waited for 3 to 5 years by simply making that accurate short-term price direction prediction. So the final thought I want to share with you before we kind of jump into some of the IM Academy services is this. As we look at price waves, market phase, etc., it's important to understand that the whole of the market can be summarized into two basic movements. In other words, price can really only do two things once it has formed two pivot points. So this red line here in each of these 4 examples represents price, and price initially comes down, it changes directions, goes up. And so where we've marked the top and bottom blue lines is just simply illustrating where the top and bottom pivots have established themselves. And from that point there, if we look at the green line, okay, which just represents what price could do, price can either reverse off of either the bottom or the top pivot point. In other words, price goes down to the bottom pivot and changes direction and goes up, or it can come up to the top pivot point and then go down. That's what's known as a reversal. So that is one potential way that price could move. The second way is what we refer to as a breakout and retest. This is very typical and is the signature feature of a trending time in the market. So, and it looks like one of these two bottom examples where price pushes beyond the lower pivot point. That is known as the breakout. As it forms this arch formation, it comes back up to that same previous level. That is known as the retest. And then it continues in the direction of the original breakout. So if it broke out to the downside, then our trend continuation move is also to the downside. So here you can begin to see how we're using past evidence or past data to make future price direction predictions. We're saying if price responded to each of these levels, there's a possibility that price will respond again. And we use certain technical indicators to provide us with additional data to make that determination. If price breaks out below or above one of these two pivot points that we have here, then we can expect price to retest to that previous pivot point and then continue in that given breakout direction. So if it's in the downward direction, we're looking for a directional bias in the downward direction. If the breakout is to the upside, as you see here on this right side example, then the trend continuation move is also to the upside. That would place a call option. So as you see this, I really want you to I want you to begin to look for these type of moves when you look at the charts. You will find that they happen over and over and over again and can give you, just from price action alone, a solid understanding of what price can do. Knowing what price can do really simplifies the whole of what it means to master this skill. As you begin to apply some of the IM Mastery Academy services, such as Cash Trap and Go Liberty and other strategies within Hourglass, understanding these price movement patterns and those possibilities will give you a dramatic head start in identifying the location and price patterns that you want to look for when you're looking for the arrows that you get within those scanners and strategies, okay? So we're going to leave it at that in terms of some of these basic concepts. And now I want to jump into showing you just a couple of examples. Let's do this directly in Hourglass and Go Liberty. Let's see here. Am I not logged in on Hourglass? Let's see here. All right, we're in Go Liberty, and Hourglass will be in just 1 second. All right, so we're going to start here on Go Liberty. So on Go Liberty is a service that is available within the HFX package for free. And it includes 4 different strategies. If you click on the strategies link here, you will see there is Simple Scalper 2.0, Pickpocket 2.0, and Web Slinger 2.0. Each of these 2.0 means that there was a previous version, and they've come out with kind of some updated indicators as well as arrows and different things to just try to make your life easier and to give you more clear indications of potential trade opportunities and trade ideas. So as we go through these, we're just going to kind of cover at a high level some of these services that are available, and then later on we'll go into more depth on how to use each individual indicator. So, but as we begin, it's important to understand, once again, market phase. Are we in consolidation? Are we in a trending time, etc.? And so as we're looking here at Simple Scalper, we'll just let that refresh. All right, so here we have the New Zealand dollar to Swiss franc. Now, right now, the big question then is, are we in consolidation or are we in a trending time of the market? Well, on this particular strategy, it includes several different indicators. One is the Bollinger Band, which includes this top red line, middle black line, and bottom blue line here. And then it also has the parabolic SAR, which are each of these dots that you see below the candles, as well as dots above the candles. And we'll go through it. We've taught this in the past. You're welcome to refer to our favorite sections in Go Live, and you can actually learn about the parabolic SAR and how to utilize this strategy specifically. But again, step 1 is to identify what phase of the market are we in. Now, we're looking right now at a 1-hour time frame chart. Let's get this color correct. We're looking at a 1-hour time frame chart. You can see this on the left side of your screen. It says 60. That's 60 minutes or 1 hour. And we can see that the candles in recent price movement activity are crossing up and down over this middle moving average line. All right, and so what that means ultimately is that we are in consolidation. When we say middle moving average line, for those who are new, It's this middle black line here. And you'll see that the candles are crossing up and down, kind of, and crossing over that middle moving average line. So anytime you see that, that is a classic telltale sign that you are in a consolidation phase. So just as we talked about on what price can do, it'll either reverse or break out and retest. Well, in consolidation, typically you are going to see price reverse when it comes near each of these pivot points. So if we just draw a couple of lines at each of these general zones here, and you'll note that because the market moves in waves, these will be either a little bit up or a little bit down from the previous pivot points. But the basic idea is that once price gets up to a previous level of resistance, one of these previous pivot points, that's where it begins to meet that resistance, turn around, and go the other direction. And we see that over and over again here as price continues to change directions in that consolidation phase. Now, the reason why we use the Bollinger Band specifically in this strategy is because it gives you a dynamic top and bottom. In other words, price doesn't always just move in a horizontal line in a perfect way. For example, we don't typically see price move like this, okay? Sometimes you'll see this kind of perfect tops and bottoms. So we'll put kind of a horizontal line here, horizontal line here. And so in this perfect scenario, we say price comes up to this line, comes down, comes up to it again, comes down, comes up to it again, it comes down, right? So there's oftentimes a little bit of a dynamic top and bottom, like you're seeing here on Go Liberty, where this top is a little bit higher than this top here. This one is a little bit higher than this one, previous one here. Even on these lower pivot points, this one goes down just a little bit lower than this previous pivot point, but it definitely turns around in that same basic zone. And this one here didn't quite make it down perfectly to the very bottom of this, but that's where it turned around. So we need other reasons. And so the reasons to take these trades. So as we look at the Bollinger Band, what this does is it says, hey, as price was pushing up, the next time it came back to the Bollinger Band was at this level rather than down here at this level. So the Bollinger Band is a statistical technical indicator that tells us 98% of the time where these candles will take place. And typically, once the candles come up to one side of the Bollinger Band, that's where you start to see some overhead resistance and for price to go in the opposite direction. And you can see that repeatedly in this example. Price comes down to it. What does it do? Bounces up. Price comes up to the upper Bollinger Band. It comes down. Very classic consolidation phase price movement behavior. And again, because we are trading HFX, we don't necessarily need a lot of distance on our trades. And so we could be correct for 2 or 3 candles here, and price just comes up a little bit. Normally in the normal Forex market, that may not be a big move, but you can still win the trade in HFX because you just need it to go in the correct direction and not necessarily go in a big distance, right? And so, so that's the basic idea of that. So again, we have 2 versions of the Simple Scalper, the original, as well as 2.0. You'll notice a few basic differences. On the basic Simple Scalper here, like I said, we have the Bollinger Bands, the parabolic SAR. We have a few volume bars. This purple line here is a 200-point moving average line, which means that it includes 200 of these candles in its calculation of the average of price movement. And that gives us a general idea for trend direction. When the candles are above that 200-point moving average line, price is said to be in an uptrend. And we can see that right here, where if you look from the left side of your screen to the right side of your screen, you can definitely see that price has been moving in an uptrend direction, generally speaking. Now, that doesn't give you the exact point of when to get in the trade. We'll talk about that a little bit more in depth later on this week. But at a basic level, again, this purple line is a good indication for general trend direction. So that can be very, very useful from that standpoint. These 2 indicators down here are the stochastics. Let me grab my brush tool here. So this one down here, this is known as the stochastics indicator. It includes a top dash line and a bottom dash line, and then a moving plot line. The black line kind of oscillates up and down. Okay, the stochastics as well as the RSI indicator, which is this indicator down here, are both known as momentum oscillators, and they do just as their namesake implies. They measure momentum, and they give us an idea for when price is overstretched in one direction or the other, as well as directional momentum, meaning does price have a lot of upward momentum? Does price have a lot of downward momentum? And there's a number of different ways to use those that we'll cover throughout this week in detail. And but for the case of just kind of giving an overview for today, just recognize that each of these indicators is designed to give us additional data or additional information to help us interpret what price is doing and to look for potential trade entry reasons. As one just simple example, when price is above this 200-point moving average line, again, we can consider that the price is generally in an uptrend. One of the ways in which you can use the simple scalper strategy, and this also applies to cash trap, is when you look at the plot line, whenever it crosses up through the blue dashed line in each of these examples, and you see that price is near the lower Bollinger Band and it's above this 200-point moving average line, then you can consider a call option for several candles. So in this particular example, you can see the price pushes down into the lower Bollinger Band line. We're in consolidation here. Price is crossing over the middle moving average line repeatedly. So we've got some good confirmation that we're in consolidation. So we kind of expect that when price comes down close to this previous pivot point, that it's very likely going to turn around and reverse again. In other words, it's like one of these top two examples. It's going to reverse at or very close to one of these previous pivot points. And so as price comes down to this level, we can see based upon this plot line that it pushes below the blue dashed line down here. And so we're expecting price to potentially reverse. But the luxury is that we can actually wait until we get the crossover. Now, you can enter preemptively, but generally speaking, it's good to see that crossover, at least with the settings that they have on these two indicators. So as you see this black line cross up through the blue dash line on both the stochastics as well as RSI indicators, and one of the things that Ness often teaches as well is you see a blue volume bar. So these bars down here, these are kind of known as the histogram bars, and they coincide with the overall movement of price. So once you have that blue candle there indicated by a blue volume bar here, you've got the cross up of both of those indicators there. That's a beautiful trade setup. You could take that trade for 3 candles. So we could count them out, 1, 2, 3. Price would close very close to the top of that range, and that would be a beautiful call option setup. All right, so that's how we would go about utilizing Simple Scalper. We recognize that's kind of a high-level overview and just one simple example of how to read a trade in that basis. But here's the point, is that utilizing the strategies, utilizing some of these indicators that are available to you within the system can really give you many trade opportunities throughout the day. And you can see each year on the alert panel, it will give you additional ideas. And it'll also tell you how much time has gone by since the most recent trade alert came out. Now, we're looking at a 1-hour time frame chart, so it's going to take a while for each trade setup to form. You can jump down in time frames all the way down to the M5 or a 5-minute time frame chart and get even more trade opportunities set up. But each of these, as you can see here, this one says this took place 29 minutes ago. This one was about an hour ago on some of these other ones as well. So each trade alert will tell you how much time has passed. If it's been a while, that's definitely not a trade that you want to take. You simply want to look for those options as they arise and look for these price patterns kind of in combination with that. So next in the line of these strategies, we have Simple Scalper 2.0. Now you'll notice a few different indicators on this chart that we can utilize for our benefit. All right, so if we drag this over, you'll notice a couple things that are very similar. We still have our Bollinger Band, which is the top red, bottom blue, and then the middle red line here. That is the Bollinger Band. We have the parabolic SAR dots. You can see those kind of below the candles here. And anytime you're in a downtrend, you'll see those candles, or you'll see those dots above the candles. And then we also have these histogram volume. These are not volume bars. These are based upon some other measures. But ultimately, they're indicating direction. When you see the blue bars, that means there's overall upward momentum. When you see these red histogram bars, overall, that means downward momentum. So you can use those in conjunction to say, okay, do I have that downward momentum? If I'm considering a put option, am I seeing some red histogram bars? Okay. If I'm considering a call option, do I see some blue histogram bars? And because you want momentum to be on your side and not against you. Down here, we also have what's known as the MACD indicator, which is a moving average indicator, and they've kind of customized it to give us an idea for where price is changing trend directions. All right. So in any trend, because price does move in waves, we're looking at price to have its kind of primary directional move and then retrace. Directional move and then retraces down, and then directional move, and it just does that for as long as the trend continues. Now, as it does so, you'll notice this line here, which turns blue when it's inside of the area, And then when it's outside, like you see up here, you'll see that it turns red. Okay, so when it's blue, you're looking for call options. When it's red, you're looking for put options. Okay, so in this area here. And when it's outside of this area, I mean, basically the color is indicating the same thing, but once again, you can look for potential put option opportunities when that line is red, or call option opportunities when it is blue. This is very helpful because during some of these retracement times, as you see when price was pulling back at each of these moments temporarily, those can be times when the line is a little bit red, but is kind of indecisive, right? And you can kind of skip those moments and wait for it to go blue again before taking those trend continuation moves. So that's one kind of way to interpret some of those indicators. All right, next strategy is Pickpocket 2.0. Once again, they've updated some of the different indicators, as well as they give us different time frames that we can trade on. The time frame chart that you're on simply dictates how long of a trade you're going to take. If you're looking at a 1 hour time frame chart, you're likely going to take a trade that's several hours long. If you're taking a 15-minute time frame chart, as you see here in the upper right, then the trade length is going to be anywhere from 5 minutes on the low end up to 45 minutes on the high end, okay, up to 3 candles typically. And so that gives you kind of an idea. So if you want to take more trade opportunities, if you want to see more trade opportunities pop up, then you can jump down in the time frames. If you want to go below M15, you can actually come here to the left side of your screen, click on the actual time frame of the chart itself. You could drop down to a 5-minute time frame chart, and you'll still get arrows indicating when to buy and sell. So within Pickpocket strategy here, we have several different indicators. One is this red line here. What this is a 200-point moving average line, an exponential moving average line, which, similar to the purple line in Simple Scalper, gives us a general idea for trend direction. So when price is below that line, we're considering that price is in a downtrend. You can see here, as price has been below it, where has price been moving? Overall in a downtrend direction. But that doesn't give us a very precise entry point. It just kind of gives us a general idea for where the trend is going. Again, our goal is to identify price direction, right? So we want to start at a high level, almost like you're in an airplane 30,000 feet above the ground. You're saying, where is price going generally? And then let's zoom in and see more detail. Let's look for specific entry points. So that red line is intended to give you a basic idea, overall picture saying, hey, all these candles are below this line. That means we're in a downtrend. If the candles are above that line, you're in an uptrend. You want to favor call options. You want to look for areas where price will likely respond. Now, this right here is a beautiful example of a classic trending time. We looked at a consolidation phase when we're looking at Simple Scalper. Here on Pickpocket, on the euro to US dollar, on the 1 hour time frame chart, we have a beautiful trending time where price came below our red 200-point moving average line, and we started to have these consistent breakout, a retest, breakout and retest, breakout, retest. These same price patterns that occur over and over again. And we'll thicken up that line so that's a little bit more visible for you. But what we're seeing here is we now can identify general locations where we might want to take a trade. And the way this works, grab a horizontal ray tool here, is once we identify several pivot points in space, we can say if price breaks below this given level, and we'll make this one blue and we'll thicken this up just so you can see it. So if price breaks below this pivot point here or above, see if we can add another one, or above this pivot point here, then price is said to be breaking out in that given direction and in a trending move. Now, because these candles are below our red 200-point moving average line, we've already predetermined that price, generally speaking, is in a downtrend. So we already have somewhat of a predetermined bias that price is moving in the downward direction. So now we need further evidence to suggest that it's going to continue in the downward direction. And so you'll note that we have a lot of arrows on here indicating buys and sells and different opportunities, but a lot of these are meant to kind of help us to identify where price is likely going to respond next. So you'll note here, this first tall vertical arrow, okay, shows up when price comes to this top black line. This is very similar to a Bollinger Band line. This is a different type of indicator, but it gives us similar information. It's giving us an idea for relative support and resistance. So as price comes up to it, we start to hit that overhead resistance. Once we get this big, tall red arrow pointing downward, we can look for a put option opportunity. We could take that trade for 3 candles, and you can see that price has moved down very nicely. Here we get another one. Price came back up to this same level, and we get our nice tall downward arrow at this point. And so we could take that for a nice put option. As you can see, price has moved down very nicely. And you just kind of do that repeatedly in the downtrending time. Now, it does not mean you win 100% of the time, but it does mean that it's going to give you better idea for where these entry locations will be, okay? And so by combining some basic support and resistance, by looking for breakout and retest zones, for example, grab our brush tool here, as price broke out to the downside here, and as it came back up to this level, look how things kind of line up. It's retesting where? To this previous pivot point, so we can see that retest at that location here. We also have this black line on top showing some overhead resistance. We've got 2 of our tall arrows. We've got other sell indications here. And so from a price action standpoint, we've got a beautiful breakout and retest. So what are we looking for? We have a directional bias straight out of the gates, suggesting that price is going to go down further. And so we want to look for trade entry reasons as to why that might occur or where we would actually enter that trade. So we have a couple different opportunities here where we get these tall arrows indicating that that's an entry location where you might take a trade. On this one here, if we took this trade just for 3 candles and didn't roll over, that first one would lose and this second one would win. Like I said, you're not going to win every single trade. Don't expect it, and you'll spare yourself a lot of disappointment because nothing is 100%, and that's okay. You don't need to win 100% of your trades in order to make money in this business, any more than Tom Brady had to win every single game in order to win the Super Bowl, right? He just had to win most of them. He had to complete most of his passes. He had to score more touchdowns than the other guy, but he didn't have to make sure that the other team scored no touchdowns. So similarly with our trading, we don't have to win 100% of our trades. We just want to win most of them, right? And and there's other elements of risk management, things that we'll talk about in other sessions that are also important as part of that overall picture. But here, even on this higher time frame, which is a 60-minute time frame on the euro dollar, we can see that by simply looking at price action behaviors, by utilizing some of these arrows, we can have good, solid trade opportunities. And that also means that we're going to skip a lot of these other arrows, all right? Some of these other arrows that are showing up, these buys, I'm already saying in my mind, okay, for now, because price is below our 200-point moving average line, I'm going to have a bias towards some of these sell indications. We want to have a directional bias. Now, you say, well, then why are these buy arrows even showing up? Well, the reality is price does move up on occasion, okay? Even in a downtrend, there are plenty of times where price was retracing. We see a lot of those movements here corresponding with these buy signals here. I'll delete some of these drawings so this doesn't get too busy. But you can see we have plenty of blue candles, right? Here's another blue candle. When this signal was going up, we got some more blue candles here. We got another retracement time here. So it's not that you could never take a call option during a downtrend. The downside of doing it, though, is that if the primary movement is in the downward direction, then that means if you add more time to your trade, if you were to roll over a trade or whatnot, that means you have a higher probability that the ending movement will go against your call option and not for it. It won't be going in that direction. And so that's why we tend to favor one direction, because if we do get more time in our trade, we want that directional bias to be in our favor and not moving against us. So reading price action, utilizing some of these indicators, waiting for these arrows to form can become very powerful indications of where price will go next. So similar to the Bollinger Band, we're in a downtrend. Price came up to this upper line, which is similar to the Bollinger Band, and that's where we want to look for potential trade opportunities. And we can also, like I said, consider any of these other arrows that show up as additional kind of final confirmations as to whether or not to take those trades. So when price is in a downtrend at the upper line of this indicator, then you could look for further put option opportunities. How long of a trade do you take? Again, 3-candle rule is a good starting point. You can go less, you can go more. There's no hard, fast rule that says you have to do one or the other. But if you're just starting out and you don't have a clue what other time to do, then go with the 3-candle rule. And that will typically give you enough time for price to move in your predicted direction. And you'll find sometimes you say, man, if I had only taken for 1 candle, I would have won. Instead, I did a 3 candle and I lost. That does happen. That's okay. Again, you don't need to win 100% of the time, but what you do need to do is know what your system is. And, and that system is what's going to help create consistency for your trading. So that's Pickpocket. Let's drop down to WebSlinger, and then we'll jump over to CashTrap in the final few minutes that we've got here for today. And then we'll continue this discussion tomorrow. So here on WebSlinger, we have a bunch of additional indicators, including the Ichimoku cloud, which is this kind of blue area here. Okay, let me grab my brush tool. So this kind of blue clouded area here, the shaded area, this is known as the Ichimoku cloud. And and when price is above that blue cloud, price is said to be moving generally in an upward direction. When price is below a red cloud, price is said to be moving in a downward direction. Now, as you can see here on the British pound to Canadian dollar, does the trend change at times? Absolutely. That's okay. But overall, what this particular strategy is very useful because as you can see here, when the price is below all of these moving average lines, which are what the web strings are, they're kind of affectionately known as the web strings, all these moving average lines. When they are all red and price is below them, note all of the sell signals. Sells just is synonymous with put option. Notice that when the candles are above, we're getting all of these buy or call option signals. All right, so we're looking for those opportunities when the price is either above or below. And so we can form once again, a directional bias, assuming which direction price will likely go next. And so anyway, so that's the WebSlinger. Again, we'll go into more detail on that at another time. But for the sake of today, I just wanted to kind of cover at a high level what you're seeing here. Again, this already has a directional bias. You're getting sell signals during a downtrend. You're getting buy signals during upward price movement. All right. And then finally, just as we wrap up our conversation today, let's jump into CashTrap. This is one of the most popular services in the I Am Mastery Academy, and for good reason. This gives us new candles, or not new candles, but new arrows every 5 minutes of the day. And so I'm going to squish down a few of these indicators. We have here 2 stochastics indicators, this top and middle one. Okay, so this one here is a stochastics. Increase the thickness there. And this is a stochastics as well. It forms differently. The S means sell, the B means buy. And then down here, we have an RSI indicator. All right, the bottom was an RSI. Now, for the sake of our discussion today, I'm actually just going to squish these down. We kind of already talked about how to go about reading these stochastics and RSI. Anytime you have the plot line crossing up through the green dash line, you're looking for a call option. Anytime you see it crossing down through the red dash line, you're looking for a put option. Now, on the top portion here, just so you can see this a little bit more clearly, we have 3 Bollinger Bands, which is, you can see the 3 green lines, the 3 red lines, and the 3 kind of orangish lines in the middle. Those are all part of 3 Bollinger Bands. Works the same as in Simple Scalper, just that there's 3 of them, and we'll talk later about why there are 3 and why that's useful. In addition to that, we have these top and bottom resistance lines. So you'll notice these red horizontal lines and green horizontal lines. These give us an idea for where basic support and resistance are. Support and resistance are simply areas where price is responding to. In other words, if we're looking at the waves of price movement and we see these different pivot points in the market, each of these areas could be support or resistance. Support just simply refers to the floor or the bottom resistance line, and overhead resistance refers to the top ones that are more like a ceiling. Support is like a floor, resistance is like a ceiling. We can generically call them both resistance lines or points of resistance, but if you hear educators refer to them as support and resistance, just know that the support is on the bottom, the resistance is on the top. Now, as I mentioned, every 5 minutes of the day, CashTrap is going to give us different arrows that show up on each candle as far as what direction the price will likely go next. It is important, though, to consider that that this is something that we want to combine with other information. We want to look at the price patterns. Right here, for example, price is coming down to this general support level. We have a green horizontal line. It's not yet quite at this previous pivot point, and it has not quite come down to this lower Bollinger Band line. Doesn't mean this isn't a good trade, but we want to combine evidence. We want to combine data to kind of tell us the overall story for what price is going to do next. And so as price is coming down to this level, we want to look for call options, especially if we're in a consolidation phase. And we see the price is just oscillating between the top and bottom Bollinger Band lines here. And you can see that we got that call option arrow forming at that general level at this green support level. And now we have price moving in the upward direction. So within just a couple of minutes, you could win that trade. If you're following Matthew Thayer's strategy, who developed the cash trap strategy, he recommends taking a 3-minute trade based upon this 5-minute chart, and then with the option to roll over up to 2 times. So that would give you potentially, depending on your broker, up to 12 minutes of time for the trade. 12 minutes because of that 3 minutes, if you roll it over, and if your broker gives you double time, that would take it to 6 minutes. And if you roll over again, doubling the time again, it goes from 6 to 12. That's how that works. Some brokers do only allow up to a 30% time increase. And so if that is in your case, if you only get a 30% increase, a lot of people like to just do the 3-candle rule. Or if you don't have rollover option at all, if you're on like IQ option or pocket option or any of those other brokers that do not have a rollover feature, then you simply just want to look for a 3-candle rule, because that's going to give you enough time for price to move in your intended direction. So that's how Cash Trap works, by simply looking for these arrows at any given moment of the day. It's important to look at key support and resistance levels, previous pivot points in the market, because again, price only will do one of 2 basic things, right? It's either going to reverse off of either the top or bottom pivot, or it's going to break out and retest. That's it. And so you can continue to watch the market literally all day long. Not that most of you want to sit on your computer all day long, but you could just literally watch for it and you say, okay, I've identified 2 pivots. Let's just see if it breaks out. I'm going to wait for it to break out. We have people who their entire approach is just waiting for a breakout and a retest. That's it. It can be very, very simple. Even though there is much you can know about the markets, you also can really simplify your overall approach and keep it simple with your trading. A lot of the Go Live educators have done just that. They just keep it simple. They form one strategy, one trade entry reason, and they just do it repeatedly. That's how you master the skill. All right. Every time Tom Brady throws a pass, he doesn't go, I wonder how I can throw the ball today. Maybe I'll put my fingers like this, or maybe I'll hold the ball like that. No, he doesn't reinvent the wheel every time he throws the ball. He does it the exact same way over and over and over again, no matter how many times he throws the ball. Same thing with every other professional athlete. They repeat the same skill over and over and over again. And so with that, as we wrap up our discussion today, I'm going to turn the time over to Brandon so that he can cover a few basic things that we wanted to cover at the beginning of this call, but he just had to take a call earlier on. But we appreciate you being with us today. We're going to cover some important things this week, including some of the questions that you've been asking. One of the questions is gapping. We'll be covering that and some other price action patterns as well. And so stay tuned. 5 days a week, we're here to help you. Appreciate you being with us. And with that, Brandon, I'll turn the time back over to you.
All right, perfect. Well, first, I want to do some recognition because on Friday, you guys submitted your flyers. Hopefully, you can see the screen here. But I want to recognize these individuals from all over the world. We had the Club 50 members. Can you guys see it? Can't see the screen. Hold on a second. Let me go back. I'm going to do this again. I want to make sure if you guys can see the screen, let me know here in just a second. There we go. So I want to recognize all the Club 50 and Club 100 winners who achieved this. They sent it over on Friday. And as I go through this, I want you to write down this email, jbboyd25@gmail.com. jbboyd25@gmail.com. So the way that this works, and you'll see as we go through this, is you have to have a minimum win rate of 70% on 50 consecutive trades. We don't care if it takes you a day, a week, 2 weeks, however long. 50 consecutive trades. Look at that, 69-0. Incredible. Awesome, Sammy. Wait till you guys see what she did this last week. I already got her record this morning. So now Club 100 is 100 consecutive trades, win rate above 70%. And you're going to see that here in just a second as I go through these. And so these individuals have achieved this. This is like a rank up flyer for people that are an IBO trying to go chairman. So it's like a rank up flyer for those who are trading. And that's why we want to feature you guys week after week after week, month after month, and even year after year, because you guys have achieved something that is very important for the world to see. And that is that you once didn't know the skill and you are now learning it. You're getting on Go Live. You're learning how to master the skill. You're learning how to fish. You're not just saying, gimme fish. If the company goes away, or if an educator went away, what are you going to do? That's why it's very important for you guys to understand that this right here that you're seeing in front of you, these are the people that end up making the most money. They are the individuals that take this upon themselves and say, I'm not just going to sit back and collect a check as if it's government assistance. I want to be able to go out there and really learn this for myself, because that's where I'm going to make the money. And that's why we have these sessions. So guys, shout out to you for doing such an amazing job. We're super proud of you. Frank Malave again, 287.0. He's taking our strategies and applying them to regular Forex. We're just super proud of you guys for doing such an amazing job. Submit your flyers for this week, jbboyd25@gmail.com. Your name, a very clear photo of yourself, and proof of your wins, losses, win rate percentage, and then send the screenshots, okay? That way that we can verify that. We're excited to put you guys up on Friday. And with that, what I'm going to do is go ahead and end the session. We're going to play some music, guys, here. Have a great Monday. Let's crush it. We'll see you at the top. Thanks, everyone.